Wallace Jones is Vice President of Training and Business Development at Member First Mortgage, LLC, a credit union-owned mortgage, CUSO. Wallace has over 30 years of experience in roles as a loan officer, appraiser, and construction lender, trainer, and public speaker. Wallace graduated from the University of North Texas with a BBA in finance. Wallace has 3 sons and a daughter and plays golf in his spare time. Katherine Mosley is an energetic and knowledgeable real estate broker from Albuquerque. Katherine holds degrees in geography and city and urban planning from New Mexico State University. Since 2003, Katherine has helped hundreds of buyers and sellers and is consistently in the top 5% of agents in the metro area. Outside of work, Katherine has 2 very active sons, aged 10 and 8. The boys have been involved with soccer, baseball, wrestling, and since the pandemic, have been mostly focused on racing dirt bikes. Katherine hopes to get back to coaching youth soccer one of these days soon. Wallace, I will hand it off to you.
All right, thank you, Jonica. Let me share my screen here, and thank you everyone for joining tonight. I think we're going to give you some very good information as it relates to home buying, and that's mostly, of course, what I am going to be focused on is the mortgage process. And excuse me here, let me get this into full screen mode here. There we go. So mostly what I'm going to focus on is the qualification process of obtaining a mortgage to buy a home, some of the products and things like that. And then of course, Katherine's going to come in and give you information about the Albuquerque market and tips on buying a home and so forth in today's market. So our topics that I'm going to cover are first qualifying for a mortgage and understanding credit, credit being one of the big players in qualifying for a mortgage. As I mentioned, talk about the types of loan products that are available to you through Sandy Area Federal Credit Union and their relationship with us and helping you maybe decide which product might be the best for you. Some tips on preparing for a home loan application when you are ready to start searching for a home and get pre-qualified for that. And then just some of the general benefits of home ownership. So when we do qualify a borrower for a home loan, we're looking really at 4 primary areas. We're looking at credit. We're looking at employment, or for most of us, that's where our income's coming from our jobs. But you could be self-employed. You could have income from some other sources, whether it be retirement income or interest income or things of that nature. But essentially, where is that source of income coming from? And then once we determine what your income is, talk about how we qualify you and determine how much mortgage you could qualify for. And then we're also going to look at the source of funds that you have available for closing, for down payment, for closing costs and things like that. And we'll talk in more detail about that as we go. So first, credit. And so I've got more slides on credit than anything else as we talk about the qualification process. Really, your credit history and your score is probably the most important factor in determining whether you qualify for a home loan, and also potentially the interest rate that you will receive. So we're going to be pulling credit from the 3 primary credit agencies that are out there: Experian, TransUnion, and Equifax. And you typically are going to receive a score from each one of those bureaus. And then what we will do is take the middle score. If you were a single applicant, if you're applying for a loan by yourself, we would take the middle score as that qualifying credit score, if you will. So if you had a 680, a 695, and a 705, 695 would be what we would use. And usually credit scores are pretty similar across the 3 bureaus, but there can be a little bit of difference in those scores. Now, if you're applying with someone else, and you're using income from that other applicant to help you qualify, of course, we'll have credit scores for both of you. And really the score that we're going to use is going to be the lowest middle score. Okay, so just be aware of that if you are applying with someone else. And please don't leave tonight thinking you have to have a 740 credit score to qualify for a home loan, because you certainly don't. But I do like to point that out. I don't know of any real loan product out there where if you did have a 740 middle score, that number one, you would not qualify, at least based on your credit, and number two, that you wouldn't get the best interest rate available for that particular product. And we'll talk more about credit scores and as they relate to products here a little bit later. Excuse me. So minimum credit scores do vary by the product type, but generally speaking, most products require a minimum 620 credit score to qualify. So how's your credit score determined? Well, there's really 5 main factors that are used by the bureaus to determine what your score is: your payment history, your capacity, which we'll talk about in more detail here in just a minute, how long you've used credit, inquiries into new credit, and really there we're looking primarily at the last 120 days, and then the types of credit that you use as well. So the most important, and the one that accounts for most of your score, 35% of it, is payment history. That makes sense. You know, how are you paying your bills on time, and have you been doing that, you know, over a period of time? And really, when I'm saying period of time, you know, we're looking backwards, of course, at how you're making your payments, but what you've done recently counts the most. What's happened the last 12 months, the last 24 months. If you do have some negative marks, if you have some late payments, some 30-day late payments or things of that nature, they certainly can and will impact your score negatively. So you know, you always want to make your payments on time, but in particular when you're preparing to purchase a home or qualify for a home loan, you want to pay special attention to that. If you have a major derogatory, and here we're talking about things like foreclosures or bankruptcies or things or repossessions, things of that nature, they of course are going to have a bigger impact negatively on your score. But again, it also depends when that happened, how long ago that was, and also have you reestablished credit since that point. And again, when I talk about product types, I'll bring that up again as to how long ago that can occur and have you still potentially qualify for a home loan. So the second factor is capacity, and this equates for 30% of your score. And so it's pretty important as well. And this is defined really by what you owe as a percentage of your credit limits. So I think the easiest way to explain that would be to use credit cards. You know, when you apply for a credit card and you're granted that card, you're given some sort of credit limit, $5,000, $10,000, et cetera. And so what you owe versus what your limits are is how we are determining capacity. So if you could have 3 credit cards and you had $10,000 limit on each one, but you pretty much owed $10,000 on every one of those cards, you know, you might be making your payments on time, and that's good for your payment history. But from a capacity standpoint, the bureaus look at that as if, all right, very heavy credit user, what's going to happen next? They're up to their limits. They're probably going to apply for a new card. Eventually, that's going to or could cause some problems in your ability to repay. So you want to pay those down. I'll talk more about that in a minute, but that's why you know, even though it's fairly common for someone to tell you, hey, you know, when you pay that card off, just close it out. That potentially could even lower your score because you now paid it off, but when you close that card, you've lost some capacity because you no longer have that limit. So, you know, pay it off, that's great, but I would go ahead and leave that open. Just not use it or use it very sparingly from that point on. Something that if you're new to the credit, new to using credit, you're just out of high school, just out of college, whatever it may be, you haven't used credit very long, it's a little harder to control this, but length of credit history, kind of looking at how long you've had it, how long you've been able to manage credit, counts for about 15% of your score. And it's looking at your oldest account and also the average age of all of your credit accounts. And again, that's 15%. New inquiries, this would be inquiries, into new credit that are not showing on your credit report yet, right? So you've got in the last 120 days, you've got a credit inquiry to target and to, maybe getting a car loan or something like that. And that's happened in the last 120 days, but there's no loan showing on your credit report yet. You'll at least be asked to explain those items. Maybe you didn't obtain any new credit, you decided not to get it, or maybe it is just one of those department stores, something like that, retail store, where they say, hey, you apply for credit, I'll give you 10% off your purchase today, and you go ahead and do that. But then maybe you've paid that off already. But at the very least, be prepared that if you do have new inquiries into credit, especially the last 120 days prior to when you apply, at the very least, you'll be asked to explain those inquiries. And again, if you did obtain new credit, those will count towards your qualification ratios that we'll talk about in a minute. When I'm talking about shopping around, I'm really specifically referring to a mortgage loan, or certainly maybe an auto loan or something like that. Often if you go out and apply for an auto loan at the dealer, by the way, you should probably be doing that from the credit union. But if you did go to a dealer out there to apply for credit, a Toyota dealer or Chevy dealer, whoever it is, they're probably going to be sending out your information to multiple sources of financing that they have available to them. So it could show as multiple inquiries, but the credit bureaus now look at that as if, okay, these all happen within a 2-week window, so it's really probably just one credit inquiry. And also, if you pull your own credit report, which I'm going to talk about in a minute, it should not impact your credit score. Types of credit counts for 10%. This is, is it a major credit card? Is it, if you have both revolving and installment loans, so you do have some credit cards, but you've got maybe a car loan or a loan for a boat or something like that. If you've got both accounts, it's a little better. The major credit cards like MasterCard, Visa, et cetera, those carry a little more impact than perhaps a department store or local furniture store, something like that issued you credit. So not a huge part of your score, but to maximize it, I guess you would have multiple types of credit. Sometimes I get asked the question, I'll just go ahead and answer it here, about, well, what if I don't have any credit at all? Because I don't want to use credit, I paid everything off. That's not necessarily a bad thing. In many ways, that's a good thing, but that can make it a little more difficult for a lender to determine your payment history. There's some alternative sources that can be used in those cases. As far as pulling your own credit report, it's a good idea to do that prior to applying for a home loan, just so you can make sure that there's nothing on there that needs cleaning up, something that's wrong, some mistake made by the credit bureau, or maybe you're finding out somebody is applying for credit in your name. There's some credit fraud going on. So it's always good to review that. And by the way, the 3 bureaus are required to give you a free credit report upon your request once a year. I would do that by calling the toll-free number that's on the screen there, or going to annualcreditreport.com to obtain that. They don't have to give you your credit score for free. However, they do have to provide you with all the data. And then once you have that, you want to again review it, make sure all your information is correct, review the credit accounts, look at the number of inquiries, if there's any other types of public records or collection accounts, especially if those are inaccurate, you want to reach out to those credit bureaus and try to get that cleaned up. If you can do that prior to applying for a home loan, it'll just make the process go more smoothly for you, and hopefully not cause any delays. So this kind of falls under the obvious category, but ways to improve your credit score. You want to pay your bills on time, obviously. Pay down your debt. Of course, my recommendation there is, if you've got multiple credit cards, look at the interest rates you're being charged and pay that highest one down first. I mean, that's just good overall for you to get rid of the one that charges you the most interest. But again, try to pay down the debt to increase your capacity. Again, don't close out those cards. That keeps your age of your accounts longer, which counts for part of your score. And again, try to limit inquiries into new credit. Well, by the way, there's a new home loan application that is being used as of March 1st of this year. And they actually ask that question now about, have you opened up any new credit or things of that nature. So that is something that's very, very important. Resist the temptation to do that before or after you apply. Make sure your loan closes first before you do something like that. And anything that changes, just so I don't forget to tell you this, whether it relates to credit or your job history or your deposit accounts or anything else, make sure you let your loan officer know that during the mortgage process, again, just to keep any surprises from happening and any potential delays of closing your loan. So as far as employment goes, we're looking for, if you are employed, working for, a company of some sort, we're going to look at your employment stability in general. We're looking at a 2-year history. And you don't have to work for the same company for 2 years, but generally want to be kind of in the same line of work, like you haven't dramatically changed careers just within the last month or two. And just to kind of give some stability there to the lender reviewing and making sure it looks like, your employment history again is stable. If you are young and new into the job market, you've just graduated again from high school or college, your education history certainly counts there. So you don't have to have necessarily a 2-year history of employment to qualify. Again, if you've been in college or in high school, to get some type of education towards that. If you do have employment gaps over the last 2 years, that's always fairly common. It's been unfortunately common here over the last 12 months with the situation we've been in there, but it's not necessarily a bad thing. You could have been laid off for a couple of months. Well, it's bad for you personally, but I'm talking about for, if you're trying to apply for a home loan, you could have had a gap there. Maybe you got laid off. It took you 2 months, 3 months to find a new job. Again, that's not necessarily going to be a negative, but you will typically be asked to explain those types of gaps to the lender or to your loan officer. We do verify your employment twice. We do that once, typically within a few days after you apply. Just verify with your employer that you're employed there when you started your position, those types of things. And then we'll do that again, usually within a couple of days of closing the loan, just to make sure your situation hasn't changed. Again, if it does, we've had situations where somebody was in the middle of applying for a home loan, they got a new job offer that they really, was sort of their dream job, so to speak. They wanted that. It was an improvement for them, more income, more what they wanted to do. That's okay. That can still happen during a mortgage application. But again, make sure that you let your loan officer know that, hey, here's what's happening. I got an opportunity for this job. If it's something like that changing, just make sure they know so we can reach out and re-verify that employment with your new employer. If you are self-employed or you're using some income from self-employment to qualify, again, we're looking kind of for a 2-year history there, and we're looking for some stability from you've been doing that for 2 years, and as we talk about income, that your income has been pretty consistent or maybe even increasing over the last couple of years. So your sources of income, again, for most of us, is our job. And you're going to be asked to, of course, document that income with some pay stubs and with W-2s from the last 2 years. But you could have other sources of income as well, interest income or rental income, perhaps. You own some rental properties. Other income might be retirement or something along those lines. Maybe you're receiving child support or alimony. That's not something you have to disclose if you don't want to. But if you need that income you're receiving to help you qualify, then of course we'll need to document that income as well. And really, for other types of income other than maybe your job, we're looking for the likelihood that it will continue for at least 3 more years. So for example, I like to give the child support example just because it's the easiest one to do. If you're receiving child support and maybe you have twins or you've got twins or triplets or something like that, and they're 17 years old, you've been receiving X amount of money a month that we can use to qualify you with. Well, if that's going to go away when they turn 18 in 1 more year, then we're not going to be able to use that income to qualify you with. So really, we can't guarantee it, but for other types of income, we're looking for the likelihood that it will continue for at least 3 years. Once we determine what your income is, we use a couple of ratios, and these are guidelines. And again, they do vary a little bit by product. We can exceed these in some cases. You may or may not want to exceed them, but these can be some kind of guidelines just to help you determine, well, how much of a payment could I qualify for? So we look at the first ratio, which is called the housing ratio, and we take 30% of your gross monthly income. So before taxes, you make $5,000 a month. We would be able to use 30% of that, or in that example, $1,500 for your sort of maximum house payment. And what we're talking about for a house payment would be your principal and interest payment, whatever that's going to be, plus a monthly allocation for property taxes and homeowners insurance. And also potentially private mortgage insurance, which I'm going to talk about here a little bit later on when we're talking about the different product types. So again, $1,500, you may calculate that if you make $5,000 and say, wow, I could qualify for a $1,500 payment. And then you may think, well, I don't want to pay $1,500 a month. I really don't want to go over $1,200. That's okay. That just gives you, the lender, a guideline that we're looking at to qualify you with. Then we look at something called total debt ratio, and we're taking in that instance your proposed monthly housing payment. So now you've got kind of a loan amount and interest rate. We calculate what your payment will be, and then we add to that other monthly obligations. And this is really debt service, if you will. So it's minimum credit card payments. It might be a minimum student loan payment. It might be a car payment, whatever you have for a monthly obligation. We add that to your proposed housing payment, and that should not exceed roughly 43% of your gross monthly income. And obviously loan officers can help you with those calculations and what your payments would be and things like that. So we also want to see what sources of funds you have available. Where's money coming from for down payment and closing costs? And I'm going to give you some examples kind of roughly what that would amount to here a little bit later. But when we're trying to document your sources, we're looking at, again, where is that money coming from? Is it coming from your deposit accounts? Is it coming from a gift that you may have available to you from a relative? Sorry about that. From a relative, typically. Is it a gift of equity? So as we're kind of going through this, first, let me talk about gifts from relatives. I mean, you can use that on different types of products I'm going to be talking about here in a few minutes. But generally speaking, we're looking at, again, you have a relative that is willing to give you a gift for either down payment or closing cost or a part of that. We're going to document that number one, they'll sign a gift letter saying we don't require you to pay that back. Now, you may pay it back, and they may actually really want you to pay that back, but they're going to sign that gift letter saying, hey, I don't expect repayment, or I'm not requiring repayment of this gift. And then we'll also just document that gift from them. Where do they have? Can they provide us with a deposit statement saying here's where the money's coming from? And all of this verification is just trying to make sure that you're not borrowing money, some type of unsecured debt, or you're just borrowing money for down payment or closing cost. You can borrow, I'm going to skip gift of equity for a second. You can borrow against an asset that you own. So for the most common example of that would be borrowing against a profit sharing account or a 401k, some type of thing your company had for you, and they allow you to borrow against that, if you will, for things like down payment on a house. Now, gift of equity is not real common, but I like to bring it up just in case it applies to anybody on the call. If you're receiving a gift of equity, and again, this is typically a relative, you have your parents or grandparents or a sibling or something like that, you're going to buy their house. They're going to sell their house, and you say, well, wait a minute, I might want to buy that house. And they say, great, if you buy it, and I'm going to give you an example here, it's worth $200,000, but if you buy it from me, I'll sell it to you for $150,000. Whatever that number may be. That's great. I just want to make sure if you're, when you still need to get a contract of sale to purchase that home, but you want to make sure it's written as the sales price is the actual value of the property. In my example, $200,000. The down payment would be your gift of equity, whatever that is, 30, 40 in my example, $50,000. And then the loan amount would be $150,000. So that's the way you want to make sure the contract's written on something like that, not what they're actually selling it to you for. And then cash on hand, I'll give you my what you really should do in that situation. If you have money in a safe or buried in the backyard or wherever you may have that money, go ahead and deposit that into a savings or some type of deposit account where that can be verified, and do that preferably 60 days prior to application. And the reason I say that is because the lender is going to ask for your last 2 months of deposit statements. So if that money is already there for the last 2 months, then you've got that money easily documented and you don't have any questions there. So it's possible for us to use cash on hand, but it's very, very difficult to come up with some budgets and some things showing how long it took you to save it and so forth. So again, if you have cash, go ahead and deposit that, preferably 2 months or more before you apply. Real quick, I'm going to talk about annual percentage rate and hopefully make some sense to you if you're not sure exactly what that means. You've got two rates you're looking at typically. You're going to get disclosures showing different rates. You're going to look at websites. You're going to look at advertisements that show you interest rates for a home loan. Your interest rate or your note rate is what your payment's based on. You're borrowing $200,000 and the interest rate's 3%. That's what your payment is calculated off of. However, there's another calculation a lender has to give you, and that's called APR, or annual percentage rate. And it really is looking not only at the actual note rate or interest rate, but it's also calculating fees they are charging you at closing, and sort of backs into a different number. So unless it's an adjustable rate loan, I'm not going to get into all the details of that, but unless it's adjustable, if it's a standard fixed rate loan, the APR is going to always be higher than your note rate, unless that lender is charging zero fee, no fees to you at all. So they're calculating those fees. And the only reason I'm bringing this up is you might have one lender tell you their rate is 2.75, and another lender says their rate is 2.875 or 3%. That actually might be a better deal, that higher rate, because they're charging much less in fees than the other lender with the lower note rate. So again, make sure you're taking a look not just at the note rate, but also the APR. So we're documenting the sources of that for things like down payment, closing costs, prepaids, and reserves. So let me kind of give you some general numbers to kind of think about that. Down payment's going to vary by product type, which we'll talk about here in just a minute. For some of you, might be zero. For most of you, it's going to be at least 3%, 3.5%, or 5% minimum down payment. So that's one thing to think about. Then you're also going to typically have closing costs. These are lender fees, they're title company fees, they're fees for an appraisal on the property, and lots of different things that go into closing a home loan. And then you also have something called prepaids, that is on a purchase transaction, your first year homeowner's insurance policy, you're typically going to pay up front. And then you're also usually going to be asked for roughly 2 months worth of property taxes to put in an escrow account. And then each month you make another payment there. So if I take closing costs and prepaids all together, I'm going to give you a number somewhere around 4 to 4.5% of your loan amount. Again, can vary, and there's other ways to pay for that, but that's just something to be thinking about in addition to your down payment. Also, most loan products are going to look at, after we document you have money for down payment, closing costs, and prepaids, you got a couple of months of reserves left. Like you've got maybe at least 2 months worth of house payments left over. And you want that as well. You don't want to spend every last penny you have on down payment and closing costs, and you don't have anything left over in savings or in reserve. So that is another thing that's usually verified and documented by the lender. All right, so let's talk about the different loan products. So conventional loans, these are loans that are regulated, if you will, or the guidelines are provided by two agencies you might have heard of, primarily Fannie Mae and Freddie Mac. They kind of set the guidelines on home loans and who qualifies for those. The maximum loan amount, and there's exceptions to everything I'm going to tell you here today. So, but the maximum loan amount in most parts of the country is $548,250. Conventional loans, by the way, make up the majority of loans that are issued out there. They're probably somewhere in the 60 to 65% of all loans that are used to purchase homes fall under the conventional loan umbrella or category. Down payments, minimum down payments are from between 3 and 5%. The 3% is reserved for two possible cases. Number one, at least one of the borrowers is a first-time home buyer. And number two, another way to do that if you're not a first-time home buyer is you can qualify if your income falls at 80% or less of the area median income. So whatever if you're buying in Albuquerque, whatever the average or area median income is, if yours is 80% or less, then you could also qualify for 3%. There is no mortgage insurance on a conventional loan if you put at least 20% down or more. And mortgage insurance, as it relates to conventional loans, it allows a lender to issue you a loan with a smaller down payment, right? Because there's more risk to the lender the less money is put down, just in case there's an issue with a loan later on. But this private mortgage insurance is a separate company that insures, looks at the loan and insures that for the lender as well. What does that mean to you? Well, it means, number one, that your payment's a little more, because your monthly payment will typically then include that private mortgage insurance. I'll just give you a $200,000 loan. It's about $165 a month, roughly. Now, that will go away either, number one, when your loan is now falls below that 80%, it's actually calculated at 78% of the original loan amount, or your property value increases. You've owned the home for 2 or 3 or 4 years and your property value has gone up. You can request the lender to drop mortgage insurance. Now, they will do that typically, but they will also usually ask you to pay for an appraisal. You're going to pay $400, $500 for an appraisal, but that appraiser, then they'll verify the value, and as long as you're now below that 80% loan to value, then they'll drop that monthly payment. So it's certainly worth it to you, even though you're paying that upfront fee. That'll be saved in 3 or 4 months, and then you'll be better off. But that's how that gets dropped. Conventional loans are usually best for borrowers who do have, again, they've saved money for the down payment. They have good credit, and I'm using a very arbitrary definition of good credit here, but your credit score is 680 or more, while the minimum is 620. On a conventional loan, your interest rate will go up as your credit score is lower. The lower the credit score, your interest rate is going to be a little bit higher. That's a bigger impact on conventional loans than some of the others I'm going to talk about. And then we calculate those ratios about what I said earlier, 30 over 43. There's ways, we could go over that 43% number, or even sometimes over that 30% housing ratio with other factors there. You put more money down, you do have good credit, those types of things. You also have FHA loans available to you. The maximum loan amount in most of the country for FHA, don't ask me why they don't round these, but anyway, it's $356,362. That's what it is in Albuquerque, although if you go into Los Alamos County or Santa Fe, that goes up. I think actually Los Alamos, the maximum loan amount went way up to $495 for an FHA. So the higher the average price of homes is in a certain area, you can exceed that 356, 362. FHA is not strictly a first-time home buyer program at all. You don't have to be a first-time home buyer, but it tends to be used more in that fashion for first-time home buyers. The minimum down payment's 3.5. Again, minimum credit score is going to be 620 right now for FHA loans. Your interest rate does not drop quite as much. So I'm going to give you a negative here in a minute about FHA, but then I'm going to jump back up and give you a potential positive depending on your situation. The negative is you have two types of mortgage insurance on an FHA loan. You have upfront mortgage insurance and a monthly payment as well, especially if you're getting a 30-year fixed rate mortgage and you are putting the minimum 3.5% down. So how much is that? Well, your mortgage upfront amount is 1.75% of the loan amount. So just to make the math pretty easy for me, a $100,000 loan would be $1,750. Now you can pay that as a closing cost, but usually borrowers opt to have that rolled into their loan amount. And then you also have the monthly factor as well. And right now, although there's talk of this changing, I don't believe that's happened yet, but that monthly mortgage insurance, unlike conventional, does not go away until you pay the loan off. So you might think, well, why do I want an FHA loan? Well, it could be better for you, again, depending on your situation, for two reasons. Number one, at least this has been consistent over the last several years, the starting interest rate for FHA loans is typically better than conventional. And also, if you have a lower credit score, if you're getting closer to that 620, your interest rate will not go up quite as much as it does on conventional loans. So again, if you do have a lower credit score, you at least want to probably ask the loan officer to do a little comparison for you to see which one you think might be best, FHA versus conventional. Ratios, again, they're stated as 33 over 41 for FHA, but that housing ratio, 33% of your gross monthly income, total 41. But again, we can exceed that depending on other factors. And this is probably the most common product used for a gift. VA loans, if you're an eligible veteran, you can get 0 down payment up to the maximum actually conventional loan amount. And that's a little misleading. We can now even exceed that because of a new act that the VA passed called the Blue Water Act. It'll allow a lender to go over and above 548 and still potentially have a 0 down payment to an eligible veteran. You don't have any monthly mortgage insurance with VA, which is great. You do, however, have an upfront funding fee The first time you use your eligibility from the Veterans Administration, it's 2.3%. So that's added to your loan amount as well, typically. But if you are an eligible veteran, then you do have your primary benefit is it allows you to have 100% financing or no down payment. You also have USDA loans. I'm gonna start moving pretty quickly here so we can move on to some other great information from Katherine here. But USDA loan is a rural development loan. It's another type of loan where you potentially have 100% financing or zero down payment. There's two qualifying factors for USDA loans. Number one, the property has to be eligible. So it has to be in a quote unquote rural area. It's really could even be in a smaller town if that town or city has less than, and I'm using some general information here, but roughly 35,000 people or less in that city, or certainly if it is out in a rural area, then typically the property will qualify. And there's also some income limits, maximum income you can make as a household. And if you have a 1 to 4 unit household in the Albuquerque area, the maximum income you could make would be $112,850. If you have 5 to 8, then the maximum you could qualify as, or excuse me, maximum income you can make as a household is $148,750. This one does have a 640 minimum credit score, but again, if you think your property is eligible out there and you think you might fit into the income limitations, then certainly you can talk to the loan officer about a USDA loan if zero down is important to you. If you need greater than the $548,350 conventional mortgage limit, that's probably going to fall under a jumbo loan category. We've got products that can go up to 3 million loan amount or above. So if you're looking for a really large home and a really large loan, that's going to fall in that jumbo category. Your minimum credit scores usually run around 700 as a minimum for jumbos, and typically a larger down payment requirement, at least 10%, if not more, depending on the amount of the loan. And then just one of the benefits of owning a home, just real quickly, and I'm going to skip that. I'll talk about that here in just a second. If you want to be prepared and be ready, you're going to want to get pre-qualified. Your real estate agent, when you are out there looking for a home, is going to want to make sure that you've qualified for a loan before they go out and start showing you homes. But you're going to need documentation. Some of this we've already talked about: your last 2 years W-2s, last 2 months of deposit statements. Usually, if you work for a company, the last 30 days of pay stubs. Self-employed, we're looking probably at the last 2 years of tax returns. Again, you want to review your credit report in advance if possible. Find a lender and loan officer you trust, and certainly San Diego Area Federal Credit Union would be a great place to go to find a lender that you trust, where you're a member of. Again, you want to get pre-approved, and you also want to find a realtor that you trust as well to help you throughout the process, whether it's contractually or with all the other things that are going on in making offers and trying to purchase a home. And then lastly, before I turn it over to Katherine, just a couple of things as far as some benefits of owning a home versus renting. I'm going to talk a little bit about tax advantages. I'm not a tax attorney, so this is not official advice. But even though the standard deduction has gone up for you if you're filing your tax returns versus filing, versus writing off whatever you may be able to do on that, you do get to write off interest on your home loan up to a certain limit. You also get to deduct property taxes before you're charged taxes on that. So usually when you own a home, you pay less in individual income taxes by being able to write those things off. Pride of ownership, this can go back and forth a little bit. And I think for today's, some of the younger generations today's, it's taken them a little longer than it has in the past. But, maybe now 30 or 35 or 40 before you want to own your first home. But a lot of people take a lot of pride in owning that home, being able to take care of that, do what they want as far as decorating, things like that. And then in the future, you can leverage the equity on that home as you start to, as your property value goes up, your loan amount goes down, you've got equity in that property and you can use that equity. You can borrow against that for, college education or home improvements or really whatever it is you're trying to accomplish. And then building wealth for most people, there's other ways. Hopefully you're building wealth as well through savings, through retirement accounts, things like that. But the wealth you build in your home for most of us becomes pretty significant the longer you own that home. And one of the things Katherine will probably talk about is increasing property values. They're going up dramatically in almost all parts of the country now and have been over the last couple of years. So, you'll find that as your value goes up and you pay that loan down, that's wealth, that's net worth to you. And for most of us, that's where a good portion of our wealth actually comes from. I'm going to leave this up for just a second. If this is, you can get this too by emailing, as Jonica said at the beginning, the marketing department at Sandia. But we have a loan officer that you can contact if you want questions for that. Ryan Deerdorf, I've got the toll-free number there, 855-636-1057. And then his direct extension is 5779 and his email address there as well. So feel free to reach out to him or again, contact Sandia and they'll put you in touch with Ryan. He'll be able to help you with any questions that you may have. So with that, I am going to turn it over to Katherine so she can share with you her presentation as well.
Thank you, Wallace.
You're welcome.
Hi, everyone, and thank you so much for coming tonight. I've been lucky enough to be a part of these home buying seminars with Sandia area for many years now. And I always try to switch up the presentation and think about what's going on in the market. So my hope is to bring you guys value this evening and impart some information that's going to help you on your journey to buy a house. So having said all that, I have put this program together for you tonight where I'd like to cover three topics. The first being the dynamics of this current real estate market and talk to you about why it's a good time to buy now and some reasons that experts are saying that this is not a bubble. And secondly, just a quick overview of the home buying process, what to expect there. And finally, some tips for being successful in this market. So let's get into the 4 reasons why now is a good time to buy. First, the mortgage rates are incredible. Last year, the mortgage rates hit all-time lows. We've seen, some fluctuation in interest rates, but they are historically low, which makes buying houses more affordable the lower the interest rate. So I was just playing around with some numbers, and at $200,000, just to give you an example of how an interest rate is going to impact you, at a purchase price of $200,000 with 5% down, which would be a $10,000 down payment, 3.5% interest rate would calculate $853 a month in principal and interest. And if I add 1 point to that rate and take it up to 4.5, your principal and interest portion of the payment goes from $853 a month to $962 a month. So that 1 percentage point in the interest rate made a difference of $109 a month. Now, of course, that wouldn't be the total monthly payment, because to that you'd have to add taxes and insurance, all those things that Wallace just discussed. So mortgage rates are fantastic, which increases your buying power. And the second reason now is a good time to buy, and this is really true in Albuquerque. And I'll tell you one thing I'm seeing is, as our property values are increasing, I'm also kind of shocked to see what the rental rates are doing. So many times when I'm working with buyers, first-time buyers particularly, when we're calculating these payments, it's like, gosh, this is a no-brainer. It's, you know, you would rent that house for more than what your mortgage payment is. At the bottom of this screen, this is a statistic that I learned probably a year or so ago, and it's always really stuck out to me, but kind of goes along with all the benefits Wallace was talking about of home ownership. But that home for many people is one of their largest wealth building tools. And the average net worth of a homeowner is over 40% that of a renter, which ties into points 3 and 4 here. So equity, we have just seen values shoot up here all over the country. In Albuquerque, I've included a graph on this slide for you that shows you what, this is on averages, obviously, but we've seen about close to 10% appreciation in the Albuquerque metro market from 2019 to 2020. We used to see more like 3% appreciation year over year. Albuquerque was kind of slow, but we've just really seen pressure on prices. So equity is growing, home prices are appreciating. And the bottom line is, if you're considering buying a home, this is maybe a good time, especially with the low interest rates today. So if you've heard any or seen any headlines and you worry because you've heard about these prices increasing, and for those of you that have been around or maybe had an experience that was not so great, or you had an unfortunate situation in the last housing bubble, I wanted to go through some of these points on the dynamics of why experts are saying this is not like the 2008 market we had, or 2006 to 8, where we saw that crash. A lot of people got hurt. We had a flood of foreclosures. So let's unpack this a little bit. The first thing I want to go over here is this time around, the housing supply looks a lot different than what it looked like in 2006 to 8. So when we look at housing supply, we are looking at that in terms of month supply of inventory. So a more balanced market is like 5-6 months of inventory. Right now, I'm seeing houses not even last a day on the market sometimes. So we have really, really low supply of inventory, which is putting the upward pressure on our prices. This time, the demand is different than the last crash. Robert Schiller from the Yale School of Management referred to that previous housing buildup as irrational exuberance, which is basically a definition for unfounded market optimism that lacks a real foundation. So there was kind of this frenzy where everyone was buying houses. And then, of course, you're probably aware that the mortgage industry fed into this craziness by just anyone could get a loan. So there's an index that kind of gauges how hard it is to get a loan. So the higher the index, the easier it is to get a loan. So in 2006, that index was at 868, meaning just about anyone could get a loan. We were seeing a ton of stated income loans, and zero down loans were a real popular thing. So comparatively, today that index stands at 124.6. So there have been a lot of changes to the mortgage industry, and we're doing a lot better job qualifying these folks. The last point under this this item would be to discuss, demographically speaking, the millennials and just simply the size of that generation. And many of them are, reaching the age where they're getting married, they want to have children. Those are two huge things that drive home ownership or the need to move. And then the pandemic has been a really interesting thing to watch how that's affected the housing market. So that, coupled with the low interest rates, is making people evaluate their homes. And we were all stuck at home for so long. So people are, saying we need more space, we need less space. Gosh, we'd like to have a home gym, or we need, offices. Now, home became everything. And with interest rates so low and equity building, a lot of people are realizing that they want to move spaces, or they want to move areas of the country. So all of that to say that put pressure on the demand. And number 3 reason why we're not in a housing bubble was, or is, I should say, that it's worthy of discussing the equity position that people have in their homes right now. And this is maybe the most important of these 3 factors to consider. So during the housing early 2000 boom, it wasn't just people that were getting caught up in the frenzy and the mortgage market craziness. It was existing homeowners started using their houses like ATMs. This is a staggering statistic, but during that time period, Americans pulled out $824 billion with a B dollars in equity. So what happened was people pulled out this money, used their house like an ATM, and then when the market dropped out, they owed so much more on their home than what the value was. And that led to an avalanche. So this, time 10, 11 years ago, we were discussing how many short sales and foreclosures were in the market. And that's not the case today. So what we know from the Census Bureau data is that 38% of owner-occupied houses in America are free and clear, meaning they don't have a mortgage on them. And then another huge percentage of them have at least a 50% equity position in their house. So this time around, people have much more equity in their homes. So the bottom line is that the housing supply is at nationwide historic lows. The demand does not seem to be letting up. The demand is very real. And even if the prices are to drop, the homeowners have enough equity to be able to weather a dip in the home values. So it's nothing like the 2008 when you look at it from those angles. The next slide I have up for you here is just some terms about the home buying process, but I'm going to skip over that one to talk about the home buying process. And the way I see this is kind of in 3 stages. So the first stage would be doing your homework to connect with Sandia area, sit down with a loan officer, and have them get you pre-qualified, everything that Wallace just talked about. And the next thing you want to do is connect with a real estate agent. So those are kind of your pre-steps. You want to be really clear on what amount you're pre-qualified for and get a really good idea of the different loan programs that are available. So if you're going to do the FHA loan, like you talked about, how much money do you need for a down payment there? If you're going to do a conventional loan, what does that look like? In addition to that, if you've never bought a house before, buying a house and financing a house, you have some costs associated with that. And part of those costs are going to be borne by the buyer. Some of them are borne by the seller. Right now, we're in a really competitive market. So you can expect to have the cost of all of your inspections and your appraisal be your cost. And it's important to kind of have an idea of what those things are before you just rush into looking at houses, making offers, and then only to find out, oh gosh, I thought I only needed my down payment. Well, no, you actually need the money for the inspections and the appraisal, and those things have to be paid up front. So I really just can't stress the importance enough of doing that pre-qualifying step and really spending some time talking either with the lender and the realtor or both. A good realtor should be able to run these kind of payments for you and be really knowledgeable about sitting down and having a chat, maybe go for coffee with your realtor and talk through all the things so that you have a really clear expectation of financially what this looks like for you before you embark on that journey. Because again, back to the low supply, which is going to be kind of really reoccurring theme here in my presentation, but everything is just moving so fast. So those are the pre-stage. Then you move into the shopping for a house phase. And again, you got to be quick. Some of these houses I'm seeing move in a day, 2 days, sometimes a couple of hours. So you really want to select a real estate professional that you know is probably a full-time realtor that is going to be available within reason to get to these properties really quickly with you when they become available. And that process of shopping for the home may take you a couple of months. It may take you 6 months. I've helped people for as many as 2 years. So that's really just dependent on what you're looking for. And one thing I'll say here is that you just really kind of need to be patient. We have great homes coming on the market. They're just selling about as fast as they come on. So it's possible that when you find a house and you're ready to make an offer, it's quite possible that you're going to be competing with other offers. And so that's the nature of the market right now. It is what it is. You might have to make more than one offer, but you will get one. So just stick with it. And once you do get one, you move into that final stage of things that happen after you get under contract. And once you have a fully executed purchase agreement, you're in a legally binding contract with the seller, many things happen. Your loan is being processed. There's title work that happens where the title company and their involvement in the transaction is to ensure that you have a clear and marketable title, that somebody's not going to come knocking on your door saying, my grandma gave me this house 3 years ago. So that's happening. We do a survey during that process. And then the home inspections and the appraisal are two big contingencies that will be items to get through before you can get to closing. Let me unpack that a little bit for you. The inspections are something that you want to do to inspect the condition of the property. And again, a reason you have a real estate broker on your side guiding you through this process is to advise you on which inspections you need and maybe give you some recommendations for who to use for those inspections. We help our buyers schedule the inspections. We attend the inspections with our buyers. We're really hands-on. Some realtors do it a different way, but that's a really big thing that happens and a very important one. And I want to just give you a bit of advice here too. In this competitive market, we're seeing that some buyers are waiving inspections. I personally think that's crazy. This is one of the biggest, probably the biggest investment you're going to make. I think home inspections are very, very important. The appraisal, on the other hand, is something that is done. So the inspections inspected the condition of the property. The appraisal is done for purposes of justifying basically that the value that the lender is lending you exists. So the lender hires a third-party appraiser to come and determine the value of the home. So there's a lot of moving parts during all of that. I went over that kind of fast. I'm happy to answer any questions. My contact info will be up on the screen at the end. So if I went too fast on any of this, or we're having a Q&A at the end, I'm happy to address any of that or answer any specific questions. So The next slide kind of talks about all the different things that realtors do, which I kind of just went through. So we're your guide. And one thing I want to tell you here too is that if you are looking to buy a house, you really need to get connected with a good realtor in this market, especially in this market. But the compensation for the buyer broker is actually covered by the seller's realtor, the seller. They pay the real estate commissions for the seller's broker and the buyer's broker. Okay. The last thing I want to cover is the tips for making a successful offer in this market. So the first one would be just to pair up with someone that you're really comfortable with, that you feel good about as your real estate broker, and really listen to that real estate advisor. Because of these multiple offer situations, it really takes skill in this market to get your buyer's offer accepted. It takes somebody who's really up to date. I think that in some instances, if you're a broker that has a good reputation, or if you're working with a broker that has a good reputation, you know what, maybe your offer has a little bit better chance of getting accepted, truthfully, than somebody that they don't know, or that, is not full-time in real estate, that doesn't fill out a contract properly. So those things are really important. So team up with somebody that you feel good about, that has a good reputation and is experienced, and listen to that person. The second thing would be to really understand your financing. What I'm seeing in this market is that because of the demand and the lack of supply, I see as many as easily 10 offers on certain segments of the market right now. So when that happens, the buyers are offering more than the list price. It almost feels like in some of these cases, like the offer or the listing price is like a reserve bid at an auction, honestly, is what it's felt like in the last few weeks. So I've seen homes that are priced at $230 selling above $250. So number two here, understanding your finances is imperative, because the reality of it is, if you're qualified up to $250 and we're shopping at $250, we may have a really hard time buying a house at $250 in this market. We may want to gear our search towards $230, knowing that if we get into a competitive multiple offer situation, we can be prepared to go up to that $250, is the conversation I'm having with some of my buyers right now. Number three, I've kind of reiterated more than once, I think, is that the necessity to be quick on your feet, be on your toes, be ready to move quickly when you see those houses come up, when your broker sends you, hey, there's a new house in, this neighborhood you're looking in. Really try to get there probably as quick as you can and be ready to make an offer quickly. And I know that's a hard thing to do, especially when you're making a purchase of this magnitude, but it really is necessary right now, at least in this market. Once upon a time, we used to have a house come on the market on a Tuesday. Hey, I want to go back to it on Saturday and show my folks. Can we do that? We used to be able to do that. Right now in this market, it's got 10 offers by Tuesday night. So you just got to be ready to move quick and kind of know that those are the rules of the game right now. Number four would be to make a fair offer. And this relates back to number one that I talked about, just to really kind of consult with your broker and say, gosh, what do you think? One thing I'm doing for my buyers right now, and I never like to tell people what to offer, but I can kind of tell them based on what I'm seeing and what I've experienced in other offers, and how much I'm seeing the delta be between the list price and where they're getting pushed up. And then I try to find out how many offers are there. I try to communicate with that listing broker. If there are 5 offers, I may advise somebody differently than if there are 15. But I want to make the point here that probably, well, if there are multiple offers, I haven't seen a property sell for the list price or less. We'll say it that way. They generally always sell for more than the list price if there are multiple offers. And I'm seeing that on almost all of the transactions lately. The fifth thing would be to see what you can find out about the seller and their situation. See how much they'll tell you. What's happening for many folks right now is they might want to sell, but they're concerned with where they go because the supply is so low. So if you can find out if there's a seller that, say, they're relocating for their job, but they need to stay in that condo for another month, could you close and let them rent back for a month? Maybe even let them rent back for free. That might get your offer chosen over one that maybe is even higher than your offer. So, you know, see what else you can find out. Is there something else that maybe the listing broker will tell you that you could use to your advantage? But flexibility in dates is a big deal right now. So that's a good suggestion I have for you with respect to how to structure a competitive offer. But the bottom line really is just to be super patient with the process. Be quick to see the home. Come in with a clean offer if you can. You've got to bring your highest and best. We're not seeing very many counter offers in this market. And just really don't get discouraged because you will find one. Next slide. Reiterating this point again, it's just really name of the game right now is staying patient in a competitive market. And look, I'm here to tell you that I had to, make the phone call to buyers to let them know, we put together a great offer, but I just found out that the seller chose a different one. And that's a phone call that I always hate to make because I'm bummed out for you. It's an emotional deal buying a house, but I'm here to tell you that usually something better comes along. So just stick with it, be positive, be patient, be ready to act quickly. Make sure that you are teamed up with a good realtor and a lender, that you have your pre-approval letter ready to go, and you're going to do great. So I'm going to put my contact info up here. If I've got my cell phone there, my email for you, feel free to call, text, or email me if I can ever help you with anything, if you have questions about what I talked about. And I'll turn it over to Jonica now, and we can have some time for questions and answers. Thanks a lot for coming tonight.
Unmute. Thank you so much, Wallace and Katherine. That was fabulous. We do have some questions, so I'll start with the first one. Should I ask for an appraisal even if the lender says I don't need one? I think, Katherine, you covered that, but let's reinforce.
Yeah, I'm happy to take that question. So in our purchase agreement, one of the contingencies that protects a buyer is an appraisal contingency. And basically what that says is that the buyer's not obligated to go forward with the purchase should the appraised value come in less than the purchase price. So you can bet that in today's market where we're having these prices come in so much over the list price, it takes a while for the closed comps to catch up to that. So we are seeing some low appraisals. And the buyer would have three options in the event that the appraisal didn't come in at the appraised value in our contract. So the first thing is that it would give a buyer the out of the contract. They could just terminate. The second thing would be they could proceed with the purchase without regard to the appraised value. So they're just saying, I don't care what it appraised for. There were 10 other people that wanted it. I'll pay the difference. If they choose to do that, it's important to know that you would have to make up the difference in cash. So just for an easy math example, if you were buying a $100,000 house, which you can no longer do, but if you were buying a $100,000 house and you were putting 10% down, so your loan amount was going to be $90,000. And if the appraisal came in, say at $90,000, they're going to base the percentage on that. So if you were bringing 10%, now you're bringing 9,000 plus the gap between the difference of the appraised value and the purchase price. So in that example, you'd go from bringing $10,000 down to $19,000 down. So that's not always an option for a buyer. And the third thing that could happen if you had an appraisal come in low would be that the buyer and seller could renegotiate a new price. However, the contract does not obligate the seller to lower the price at all. So it is definitely something that it's a hurdle that we're dealing with. And I would say to a larger extent all the time in this market. So if the lender says you don't need one, it's totally up to you. We're seeing some waivers. If you've got a lot of money down and you're, feeling okay about it, then I suppose you could save that $600 charge.
Well, this is kind of related, but it's not about the appraisal, but the inspector. How much does it typically cost for the home inspector?
I would say on any house, at a minimum, what my advice would be to get a full home inspection, and those run $350 to $450 depending on the company. A sewer line inspection at about $150 to $180, and a termite and dry rot inspection, which is another $80. And then depending on where the property is located within Albuquerque and other types of systems, you might want to have some more specific inspections, like if it has radiant heat, I'd have somebody look at the boiler. Some areas of town, it's more advisable to get a radon test. So I would probably say it's safe to budget $1,200 to $1,500 on the high side for inspections, and probably $800 on the low side.
It can all add up, can't it? But you're looking at a huge investment, so you need to be safe with what you're doing. I have another question. Should I consider buying a foreclosure?
I think foreclosures are a good option. The thing to know there is that they will not do any repairs. So back to the inspection question, you can still do inspections on a foreclosure. They give you a really short time window, and they make you sign 1 million addendums that say it's as is, it's as is, it's as is. And they won't do anything. So, worst case scenario on a foreclosure, if you spend the money on inspections and decide it's something it's more in repairs than you want to do, then you have an out in those contracts. I don't think they're always a better deal by the time you put all the work into them as a market house, and there are not very many of them right now.
No, I agree. I think we can ask, does Sandia offer a first-time home buyers program? Yes, we absolutely do. So another question is, can Sandia get you a loan for a house in another state?
Yeah, I'll take that one. So the answer to that is yes, in the relationship with Member First. There are a couple of states. I think there's 4, but we're talking about New York and a couple of those types of states where we may not be able to. For the most part, we can lend to Sandia members all across the country.
That's wonderful, and that's how we try and cater to all of our members that might be moving across the country or doing other things. Like, we're here for you, however you want to contact us. There's another question, Wallace, you might want to take this one. Should I pay points for a lower interest rate?
Yeah, so you certainly can do that. Generally speaking, when you're quoted an interest rate, it is at what's maybe called a par rate. But if you If you have some extra funds that you save for down payment and closing, and I think another key factor is you intend to live in that house for a long time. I mean, I think I would, if you think I'm going to be in this house for 10 years or beyond, then you can generally get a lower interest rate by paying what's called discount points at closing. So generally speaking, each 1% or one discount point, that would be 1% of your loan amount, you would pay at closing, you would get about a quarter of a point better interest rate over the life of the loan. So, it's going to take you a few years to make that back because you're paying some upfront cost for that, but you'll make that back. And if you stay there for a long period of time, then you'll actually be better in the long run. So it depends on your situation. Do you have those funds available, number one? And do you intend to live in that house for a long time?
Thank you. Another question that just came up was, do I get a better rate with a higher down payment?
Yeah, I mean, you can do that. Certainly, there's a couple of factors there. So let's talk about conventional loans, number one. Again, the one's the most common. Number one, if you put more than 20% down, as we already talked about, you don't have to pay private mortgage insurance. So that's not a lower rate necessarily, but it's less money out of your pocket each month. And then number two, yes, the more money you put down can give you a better interest rate. And maybe another way to look at that is the less money you put down, your rate might go up just a little bit over what the quoted interest rate would be. So the answer to that is typically yes. And just ask your loan officer about that. They can help you calculate, number one, well, what if I put 20% or 25% down instead of 10 or 15%? They can calculate those payments for you and let you know the difference there.
Okay, and another one that just came up with, should I get a 15 or 30-year mortgage?
Yeah, well, again, I'll take that one, I guess. That's again, dependent upon your situation. The advantages of a shorter term are usually a better interest rate, right? You get a lower interest rate, typically the shorter term. Now your payment may still be higher because you're paying that back over a much shorter time period. So it depends on your comfort level. I think if you're comfortable with whatever that payment is on a 15-year mortgage versus a 30, I would certainly probably do that myself. I mean, again, your payment might be a little higher, but you're paying that loan off much more quickly. You're paying less interest over the life of the loan. And you're building equity in that property much more quickly. More of your payment is going to pay down principal of that loan versus the interest charge.
Well, thank you. We are coming down to the last couple of minutes of the webinar, and I so thank everybody for attending, and especially Katherine and Wallace. You guys are definitely the experts in this industry as well as in this market. So thank you so much for spending your time with our members today. And I think we're going to, close up on this. And if there's any people that had question and answers that we did not answer, I will make sure we get, if you send me your email address in the Q&A, I can definitely get it to the right person.
That's good. Thank you.
Thanks, everyone. Thank you for coming.
Thank you. Have a good evening and good luck in your home buying process.
Have a good day. Thank you.
Hey, Jonica.
Yeah.
There's a few questions there. I don't know if you want to, if those people, if you have their information, there's one.
Let me close this and I'll.
Okay.